The American car insurance market just crossed a breaking point. The average driver is now paying over $2,200 a year for coverage, up more than 40% in just 3 years. But here is the thing. The drivers getting hit hardest are not the ones with accidents or bad credit. They are the ones who did nothing wrong except stay loyal. There are 2 types of car insurance customers right now: the ones who reshop every year, threaten to cancel, and play the system, and the ones who auto-renew and open their renewal letter like a utility bill. One group is getting deals, the other is getting fleeced. Here is what your insurance company will not tell you. They have a name for the second group. They call you price inelastic, and they have built entire algorithms around finding you, scoring you, and charging you as much as you will tolerate. Smart drivers are not loyal anymore, because in 2026 loyalty does not get rewarded, it gets invoiced. Stick around until the end, because the final company on this list hit its own customers with 2 consecutive rate increases inside a single calendar year, and regulators stopped them from taking over $53 million more out of your pocket. Number 10. Allstate built one of the most trusted brands in American insurance on 3 words. You are in good hands. For decades that promise held. Then came the algorithm. Today, Allstate is the most documented case of deliberate loyalty exploitation in U.S. insurance history. Unsealed court documents filed before a California administrative law judge reveal Allstate used a proprietary pricing algorithm to systematically overcharge loyal customers by an estimated $1 billion over 10 years. Customers with 0 changes to their driving record have reported 25% renewal hikes with no explanation beyond policy adjustment. Allstate's algorithm calculated a price elasticity score, a number measuring how likely you were to accept a rate increase and stay anyway. The higher your loyalty, the worse your rate. Translation: staying longer made you a more profitable target. California regulators identified that loyal customers were receiving smaller than entitled discounts specifically because the model predicted they would not act. Money gone, no claim, no accident, no explanation. Bottom line, Allstate's good hands were busy picking loyal pockets. But if you think Allstate is shameless, wait until you see what farmers got caught doing to customers who had been with them for 9 years or more. Number 9. Farmers Insurance. Farmers built its reputation on the local agent, the person who knew your name and sat across the kitchen table when you signed your policy. That relationship became the very tool used to keep you from asking questions while the algorithm quietly charged you more. And get this. A California Insurance Commissioner investigation found farmers systematically failed to give long-tenure customers, those with 9 or more years, the full discount their risk profile entitled them to. The overcharge ranged between 4 and 13% per year, totaling between $26 million and $29 million annually in excess premiums. A class action lawsuit settled for $15 million. There is a dedicated settlement website. Farmers used price optimization and elasticity scoring to identify passive customers who would absorb higher rates, a direct violation of California's Proposition 103, which bans using non-risk factors to price insurance. The real kicker is this: the longer your loyalty, the deeper the penalty. Farmers planted loyalty and harvested cash, just not yours. But if you think farmers went after loyal customers quietly, wait until we talk about a brand that charges you more with a smile and a cartoon mascot. Number 8. Geico told you that you could. Geico told. Save 15% in 15 minutes. What the Geico does not mention is what happens to that rate after year 1 or year 11. An 11-year Geico customer received a 40% rate increase at renewal. The representative's entire justification: one word: inflation. After switching to USAA, that customer paid less than they had before the hike. Industry exit data consistently shows Geico customers who reshop land at Progressive at significantly lower rates for equivalent coverage. Geico operates as a direct-to-consumer carrier with no agent middleman, which sounds like a feature but is actually a firewall. Rate changes arrive as a PDF or a push notification. There is no one to advocate for you inside the system. Meanwhile, Geico's parent, Berkshire Hathaway, reported over $1 billion in insurance underwriting profit, a figure that tells you exactly how that pricing model is calibrated. And get this, Geico's 6-month policy structure creates a twice-yearly opportunity to adjust your rates upward. Competitors' customers get 1 renewal negotiation per year. Geico customers get ambushed twice. The Geico waves goodbye to your wallet at every renewal. 15 minutes to get in, a decade to realize you have been overpaying. If this is the first time you are hearing how these companies actually work, this channel is your consumer protection watchdog. Hit that like button so more drivers see this before their next renewal letter hits. And subscribe so we can keep pulling back the curtain. Geico uses your loyalty quietly. The next company does something far more brazen, a bait and switch that happens before your first renewal even arrives. Number 7. State Farm. State Farm is the biggest insurance company in America, number 1 in market share, the most agents, the most brand recognition, and it has used every bit of that scale to perfect the post-binding rate adjustment. State Farm customers have reported receiving rate increase notices within 60 to 90 days of joining before their first renewal, due to back-end underwriting finalization. Separate cases document $800 annual increases sent mid-policy with zero changes to driving record or coverage. Illinois regulators tracked State Farm preparing double-digit hikes across both auto and home lines simultaneously. Here is the thing. State Farm's quoting system generates an initial rate that gets revised upward after internal underwriting finalizes. One number at sign-up, a higher number shortly after you commit. Technically, the fine print allows it. Practically, it is a bait and switch. Customers fleeing another carrier's rate hike often discover they have traded one overcharge for another. Reshopping those same customers to Progressive frequently reveals savings of 33% or more at identical coverage levels. State Farm is like a good neighbor who quotes you low rent and revises the lease after the moving truck leaves. The next company hides behind a maze of subsidiary brands specifically designed to make comparison shopping structurally difficult. Number 6. Liberty Mutual. Liberty Mutual told you to only pay for what you need. The fine print never mentioned that what you need would cost more every renewal while a new customer next door accessed a rate you can no longer touch. Consumer Watchdog intervened against Liberty Mutual rate hike requests in California, saving policyholders over $53 million in excess premiums. Industry switch data confirms Liberty Mutual is among the top carriers customers abandon when they reshop, hemorrhaging market share directly to Progressive. Liberty Mutual operates through a web of subsidiary brands including Safeco and multiple regional labels. Translation: the company built a pricing labyrinth around itself so you cannot accurately measure what you pay versus what you could pay. Every dollar of Limu, Emu, and Doug's relentless ad campaign is baked into your premium. When Liberty Mutual loses customers at scale, the loyalty tax on those who stay gets heavier. Liberty Mutual gives you freedom. Freedom to overpay in silence. Only pay for what you need, as long as what you need is whatever they decide to charge at renewal. Here is what I want to know right now. Have you ever opened a renewal letter, seen a rate increase with zero changes to your record, and just accepted it? Drop the company name and the percentage in the comments. I want to build a real-time map of which carriers are hitting customers hardest, and which states are letting them get away with it. The next company tracks your driving with an app, and uses that same data to decide how much more it can charge you. Number 5. Progressive made comparison shopping mainstream. Flow. Name your price. Transparency was the entire identity, and then, once it became the industry's largest new customer magnet, it quietly learned the same tricks it helped customers escape from. Progressive wins more switching customers than any other carrier by being aggressively cheap at acquisition. But Progressive is also documented applying the same post-binding rate adjustment as State Farm, a practice so common that competing agents specifically warn incoming customers about it. Industry churn data shows those same customers cycling back out within 1 to 2 years. Progressive's Snapshot Telematics program harvests your driving data, hard braking, mileage, time of day, speed patterns. Translation: the app that recruited you with a discount is simultaneously building the actuarial case to charge you more at renewal. The real kicker: customers who reshop every 12 months can stay ahead of Progressive. Customers who settle in become the revenue base that funds the next round of aggressive acquisition rates. Progressive is the wolf dressed as a sheep. It wins your business by showing you everyone else's price, then sets a price you did not see coming. The next company built its trap on something more classic: your agent's commission check. Number 4. Nationwide, on your side. When your rate goes up, your agent's job is to keep you on Nationwide, not to find you the best rate on the market. Those are not the same thing. Industry switching data shows Nationwide customers leaving for Allstate when they reshop, meaning Nationwide is less competitively priced than a company already on this list for documented loyalty penalties. Nationwide's captive agent structure creates an inherent conflict of interest. An agent earns commission on renewals. A renewal at a higher rate generates more commission than a lower one. The agent is structurally positioned to absorb your frustration, offer a minor internal discount, and move on. And get this, Nationwide's On Your Side review is marketed as ensuring your coverage fits your needs. But a review conducted by an agent who can only sell one company's products is not independent advice. It is a retention call with branding. On your side, just not the side of your wallet. Nationwide is the insurance equivalent of asking your landlord to negotiate your own rent. The next company has 160 years of brand credibility, an actuarial complexity so dense you cannot fight back. Number 3. Travelers. Travelers has been in business since 1864. Over 160 years of trust, deployed to make existing customers comfortable enough to stop questioning their renewal price. Travelers consistently ranks among the top carriers customers abandon for Progressive, confirming its renewal rates are systematically uncompetitive. As a commercial and personal lines hybrid, Travelers applies territory-based pricing adjustments, model year surcharges, and regional claims trend modifiers. Technical justifications nearly impossible for the average policyholder to challenge. Translation: the math always makes the rate increase look justified on paper, even when your personal risk profile has not changed at all. But here is where it gets truly calculated. Travelers markets itself as a premium carrier, charging above market rates on the assumption that quality-conscious customers will pay more for the brand. And that premium positioning is itself the loyalty trap. Customers who believe they have the best coverage are the least likely to shop around and discover they do not. Travelers will take you on a trip. Destination: a higher premium every renewal, justified by math you cannot read, for risk you did not create. The next company literally named itself after the community it serves, then led the nation in rate increase velocity. Number 2. American Family Insurance. You cannot get more trust-forward than naming your entire company American Family. For decades it worked. Midwestern families, local sponsorships, community roots. Then American. Family led all national insurers in the rate of premium increases in 2024. The company named after American families was the most aggressive at raising rates on them. American Family posted the highest rate increase velocity among all major national carriers in 2024, outpacing even State Farm and Allstate. Its captive agent model creates the same structural problem as Nationwide. Agents can only sell American Family products. When rates go up, your agent cannot tell you a competitor has a better rate. That single fact is worth more than any retention discount they will ever offer you. Bottom line, American Family customers on auto-renew are the company's most profitable accounts. That trust is not a protection. In 2024, it was a premium invoice. American Family, because even your family charges you more when they know you are not going anywhere. And now, the final company. This one stacked 2 consecutive increases within a single calendar year, and regulators caught them mid-reach. Number 1. 21st Century Insurance. 21st Century Insurance launched promising to eliminate the middleman, cut costs, and pass the savings to you. It is now a California subsidiary with a rate increase stacking records so aggressive that consumer advocates had to intervene in open regulatory proceedings to stop it. And get this, 21st Century sought an 18.4% rate increase on automobile policies in California, filed directly on top of a separate $29 million increase that had gone into effect in January of 2024. 2 material hikes, back-to-back, same calendar year, same policyholders. Consumer Watchdog challenged the second as excessive, saving customers more than $53 million combined. But here is where it gets truly outrageous. 21st Century's hike was built on inflated projected loss assumptions, meaning the actuarial team modeled future claims costs at artificially elevated levels to manufacture a justification for the increase. Translation: they invented the math, and a regulator had to audit them to catch it. Without that intervention, customers would have absorbed a compounded double increase within 12 months that no driving record, no claims history, and no policy change by anyone could justify. 21st Century Insurance is living in the 19th century when it comes to respecting its customers. They did not just reach into your wallet, they filed paperwork explaining why your wallet owed them more, twice, in the same year. The insurance world is a battle between algorithms hunting for passive policyholders and drivers who refuse to be prey. On one side, pricing models designed to identify exactly how much they can raise your rate before you act. On the other, drivers who reshop annually, call to cancel, get transferred to a retention specialist, and walk away paying less than the year before. Here is the one move that neutralizes every company on this list. Every single year, get at least 3 competing quotes before your renewal date, then call your current carrier and say you are canceling, not, "Can I get a discount?" Canceling. That word triggers a retention process your agent's standard toolkit cannot access. The pricing system that built your loyalty trap has a backdoor, and the word cancel is the key. That is what Motormind is here for, to hand you the keys they do not want you to have. If something in this video is going to save you money before your next renewal, hit subscribe and turn on notifications. New episodes drop every week, and every single one is designed to save you from a costly mistake the industry is hoping you never catch.